All right, thank you. So I'm going to go ahead and share my screen real quick, which should bring us to the presentation we're going to be covering today, which basically is paying yourself first. So just give me a couple of minutes while I kind of take this into presenter mode, and then we'll be able to get started. All right, so today's session, paying yourself first, building knowledge, security, and confidence, right? So this is just one of the second of the 6 sessions that we have lined up, just, in conjunction with the FDIC, for Money Smart for young adults. So with that being said, let's kind of go over what the objectives are going to be today, right? So first and foremost, we're going to kind of go through why it's important to save. Secondly, we're going to cover identifying kind of your individual saving goals, identify the various saving options that we have in place, or that are in place, and then of course determine which saving options will help you reach your savings goals, right? So that's going to be the 4 key objectives that we're going to go through today. And as we go through each particular slide, different slides of the presentation, this will definitely come to life. And then, of course, if you have any questions, I'll definitely pause at some point to get your questions or anything else that may come up. All right, so to kick things off, we're going to be talking about, do we spend or do we save? What should we do? So here's just a quick slide, a quick example of, 2 ladies having a conversation, and I'm sure you guys can read this on the screen, but it's one person saying, hey, I just got a check from my grandmother for my birthday, and now I can buy that purse, that I really want. A friend is saying, hey, the purse is, costs a lot of money. Don't you want to at least save some of that, the money or check that you got from your grandmother? Then, the response is, well, what else do I have to pay for? It's money. If I want to spend it all on the purse, I can. So here we've got, this conversation of where one person is saying, hey, I've got some money that's coming in. And then you have the option, do you save it or do you spend it, right? That's what it's going to come down to. That decision is going to be really, really critical. And I'm sure we'll kind of, as we go through the slides in the training session, this conversation will pick it up at the end of the training session. So this is to be continued. So with that being said, let's talk about paying yourself first, right? So what does it mean to pay yourself first? And what it comes down to is just basically putting some money in a savings account before you buy anything or pay bills, right? Now, what does that really look like in reality? For some people, it could be a percentage, 5% per paycheck. Is it 10% per paycheck? Is it a fixed dollar amount, right? That will vary, from person to person, depending on what your, income looks like. But ultimately, just getting into a habit of savings is really, really important, because it'll definitely put you on the path to what we call, financial freedom, financial independence in the long term. And then, okay, we'll kind of go, kind of look at what the benefits are of paying yourself. So first and foremost, when we think about paying yourself and savings, essentially we learn how to manage money better, right? We save money towards identified goals, right? The goal is to definitely improve your standard of living. And last but not least, having money for emergencies, right? So I'm sure when you're looking at these 4 points that are on the screen, at some point, these may have come across, you may have actually thought about these or kind of even planned towards. So when we think about saving money towards an identified goal, maybe you're looking to purchase a new home, right, in the coming years, or maybe you're looking, to, look at some investments or anything else related to it. Maybe you've got, a child or, a kid that's going to be going to college, and kind of not instead of having to borrow more money, you can actually save money for, education and tuition and all these things. So paying yourself first will enable you to achieve these goals. And when we think about standard of living, right, that's also going to vary across the board, right? Because what might be comfortable for one person might not seem comfortable, but whatever you feel would be, and give you the ability to kind of, elevate your standard of living, then paying yourself first puts you in that position. Now we all know, I'm sure from day to day, life experience, and life is totally unexpected. Emergencies are never planned for, whether it's a medical emergency, whether it's something that breaks in the home or an appliance that needs to be replaced. Hey, if you've got the money saved, instead of having to go put it on a credit card, or, use any other means of payment, you basically can take the money out that you've saved to cover that emergency that may have come up. So the benefits of paying yourself are listed here. And ultimately, it's just about managing our money and working towards an identified goal and having, extra money to deal with emergencies that may come up. So with that being said, I'm not going to go through this, but if you're looking at the activity worksheets that was sent to you, here's the first activity you can complete, after this training, or, working with the folks, to kind of figure out how they would want you to do this. But when you think about completing the activity guide, activity 1, your participant guide, what we want to do is write down what your goals are for the future, fill in the top half of the worksheet, and then fill in, the second half when, we instruct you to kind of do so. But this is something that should have already been made available to you. This is a resource that you can, utilize, and fill out at your own time. But I just at least want to go through this because this is something that is part of the activities that we're going to be covering as part of the training. So with that being said, let's talk about how you can, how your money can grow, right? So how do we basically, enable our money to grow? Well, it comes down to, first and foremost, is our money earning us any interest? So for anybody that may establish like a savings account, there'll be an interest rate that you're able to earn on that amount that you have saved. And basically what it comes down to is interest is paid, to you for keeping your money deposited with financial institutions. So whether it's a Chase Bank, whether it's a Wells Fargo, Bank of America, or even ourselves at Citibank, you can open up a savings account, with the respective, with the 4 largest banks that are out there. As you're opening up a savings account, they'll inform you, hey, this is the percentage that, of the money that you're going to be able to earn on your account. And that is kind of, done over the course of a year. In addition to that, we also talk about compound interest. This is money earned on previously paid interest and money already in your account. So we think about standard interest first and then compound interest, right? So the larger the deposit in the account, the more money it's going to earn for you over a 5, 10, 15, 20-year period, right? And then we also think about that compound interest. So as you begin to earn interest on that money, and you're depositing more money, the compound interest is something, is what will be paid in addition to what was already previously earned in terms of interest. So really, really important when you think about opening up a savings account with any respective bank, or even if you have an existing savings account, just kind of determine, hey, how much money, is my savings account actually making for me? And depending on what your financial goals are, how much money you would want to earn in put aside, in the next 5, 10, 15, 20 years, that will then essentially tell you what you need to have in terms of a deposit, because how much money you would need to have in the bank each year that goes by for you to be able to achieve that in terms of interest. So your money can grow through earning interest as well as compound interest. And then we, kind of want to go into kind of what the average, what we essentially be determined as annual percentage yield, right? APY. And I'm sure you've seen this, when you're opening up a savings account, if you're in a position of a savings account already. So this is the amount of interest you can earn on a yearly basis. Includes the effect of compounding, right? And when you're kind of out there shopping for, think about, hey, where can I save where can I, put my money? How much interest can my, money earn for me? It's really good to kind of compare, all the annual percentage yields of the various saving products and not the interest rates, right? So think about it as, hey, what does this look like over a year? And then kind of make the determination where you want to put your money, right? Because essentially you want your money to grow, and that's going to, and that's really, really critical, part of it. In addition to that, I'm just going to kind of go over a quick formula. And this formula is actually referred to as the rule of 72. It's a formula that lets you estimate how long it will take for your savings to double in value. So the formula is 72 divided by the interest rate equals the total number of years, right? So 72 divided by the interest rate will equal the total number of years, right? So if you're looking to double your savings, right, over the next, 20 years, this is a pretty good rule to kind of look at. So depending on the number of years you are planning to have that money in, and have it, double in value, this is the formula that, that is used. So basically what it comes down to, 72 divided by interest rate of 4% equals 18 years. That's how long it will take you to double your money, right? To kind of double take your savings to double in value. In addition to that, you can look at it the reverse way. 72 divided by 12 would basically equal a, annual rate of 6%. And then 72 divided by 20, depending on the total number of years, would then equal an annual percentage of about 3.6%. So if you've got a, an opportunity to, with the focus of doubling your value, look at what the APY looks like and say to yourself, hey, in the next, 12, 18, or 20 years, here's what my value would look like. So this rule of 72 is really, really critical. And even if you're walking into a bank and you're talking to somebody about, hey, you know what, I'm going to be investing some money. Here's kind of what my, my plan is. Here's what my initial investment's going to look like. Here's what I'm looking to basically earn in the next 5, 10, 15, 20 years. Kind of having the rule of 72 in place will kind of let you know how long it's going to take you based on the current interest rate that they're offering you to be able to achieve this goal. So really, really important. Go ahead.
So there's a question.
Go ahead.
Where do you get the interest rate? So is that
the interest rates are going to be based on the product so each bank will have various savings accounts in place, and they'll determine how much interest your money is going to earn over per year. So if you're opening up a savings account and they tell you, hey, you're depositing $20,000 in your account today, here's what our APY looks like, here's how much you'd be able to earn in the next 12 months. So basically, the financial institutions will let you know kind of what's in it for you in terms of percentage as well as how much you can earn. Does that answer your question?
Yes, that answers the question.
Thank you. All right, so then we think about savings products, right? So this is where we're going to kind of go into depth. So we think about the rule of 72, right? And what that looks like in terms of doubling money over the span of years. Let's talk about the different types of saving products, right? So you've got savings accounts, you've got money market deposit accounts, right? Then we've got certificate of deposit, which are CDs, right? It's very, very important to choose a savings account that is FDIC insured, right? Federally insured. Why? Because that means in the eventuality that anything happens to the bank, like we saw years ago with a lot of banks that went under, a lot of people that had their savings, right, in those banks, because those banks were FDIC insured, the federal government comes in and basically says, hey, you know what, there'll be no loss to the customer. We'll be able to kind of ensure whatever assets the bank will have in place. In addition to that, just calculating kind of what your insurance coverage is going to look like, right? So when we think about it, here's a resource that you could, utilize, and this is just based on what they call electronic deposit insurance estimator. myFDICinsurance.gov. This will kind of give you some additional information on kind of what the coverage looks like based on the different types of saving products that are out there, right? So this is just some information. Be good to, if you just want to take a screenshot of that, you can kind of do more research on your own, depending on which saving products you want to look at. But then it also just gives you information that the FDIC is the federal government's put in place related to the different types of savings accounts. One thing you want to do is just make sure that the product, wherever you're depositing your money with, that they have, that they're FDIC insured, because you don't want to have to, have any losses should the bank go under. With that being said, it brings us to activity 2, which is kind of related to our savings product. And in your activity guide, when you get an opportunity, determine which saving products would work best for each situation, right? So this is going to be part of the activity guide. related that we've provided for yourselves. Does anybody have any questions on what I've covered so far? Anything else that may have come up? I don't have visibility to chat. So if there is, I'd be more than happy to take those questions now. If they,
There are no questions in the chat, but I will chime in when there are.
thank you. All right.
Oh, wait, we do have a question. Sharon, do you want to unmute yourself?
Okay, so hi, and thank you for being here again this week. I'm looking in the Money Smart for adults module 3.
Okay.
And is there a specific page that I should be looking at for this evening's for the activities that you're encouraging me to?
So I think, yeah, these would probably have been sent out. If not, I can always have.
No, I have it. I'm just looking for the page.
I'll put that I'll open it up and put it in the chat for you.
Okay, thank you.
Yes.
Okay.
Thank you. Appreciate it. All right. So we're going to talk about non-deposit investment products, right? So when we think about it, investments, long-term saving options, purchase for future income or financial benefit, right? These are not FDI insured or bank guaranteed, so you could lose all your money, right? And you may earn and grow more than a regular savings account, but because of the risk, that's a risk you have to take related to non-deposit investment products. So the most important thing, the one thing that everybody definitely wants to encourage from a financial perspective is if you're going to put money into any institution, what is the risk, right? Because in a lot of instances, some people are like, hey, deposit your money, you can earn this amount of interest or, XYZ dollars, whatever the case might be. And it may seem tempting, but you always have to ask yourself, like, what are the potential risks? Should that not be achieved? And in addition to that, while it might seem like your money might be able to grow faster for you, is the risk worth taking? And there's one thing that I can just tell you, and I'll share this as well later on in the session. I've learned this from personal experience. Don't invest money that you're not prepared to lose, right? Because when you start, looking at some of these non-investment products, it might seem, really, really good and, an opportunity to make extra money. But I can just tell you from personal experience, it doesn't always work. It doesn't always work because there's always a risk factor. And in some instances, just the overall transparency around these accounts, I'm not knocking them in any way, shape, or form. But if you're going to put money into a savings account, just put into an account an institution that is fairly insured, because the losses, can really mount up. And some people will be like, oh yeah, well, I'm only going to invest 1,000. I'm only going to invest. Well, if they're prepared to lose that money, then go ahead and do it. But if you're not prepared to part with that income, then the best thing you can do is just make sure that everything you are doing is with an institution that is FDIC insured, because that's just more of a peace of mind while you're at home, regardless of whatever the situation might be, regardless of whatever happens, with that institution. Hey, the federal government is coming and saying, hey, they've met all the requirements, and whatever deposits you have in place, that's what you'll be able to get back. Then we're going to talk about the different types of investment products, right? So some folks on the call may already be aware of these: stocks, bonds, mutual funds, U.S. Treasury securities, and of course, retirement investments, right? With any of these products, right? We'll talk about stocks. So essentially, there's so many, different companies out there that, you can literally look up, companies that give you an opportunity to buy stocks through them. I'm just going to use one, for example, just one that I'm familiar with, E-Trade, right? So essentially, you go to E-Trade, set up an account, deposit money into that account, and then at that point, you're then basically buying shares for a company. And anytime you're purchasing stocks, same thing, there's a risk factor, right? As as the share price tends to increase, then hey, you're making money back. But if the share prices drop, then essentially anything that you may be looking to receive in terms of dividends or profits, is completely at a loss. So for most folks that are looking at the various financial markets, whether it's the New York Stock Exchange or any of the others, it's kind of like you can, if you're going to invest in any type of stocks, just kind of have enough information about the company. And in most instances, the company should be, transparent in showing their portfolio and what they're able to provide in dividends, because the value of your investment changes, right? And it goes up or down depending on the stock market. I'm sure we've all seen it, like even if you just, watching your local news in the morning and you're looking at all the indexes that are kind of just, running through the bottom of the screen. Hey, there's days where the stock market has a rally and there's days where the stock market has crashed. And depending on who you own shares with and kind of what the overall viability is, essentially you could still kind of come out of it without losing money, or you could actually essentially come out of it where, it's a total loss. So whatever money you've invested for a share, if you're buying a share at $20 and it goes up to $40, great. But if you're buying a share, one share, for the stock at $20 and a week from now it's at $5, you've just lost $15 per share. So it's really, really important to understand that the value of your investment in anything related to the stock market will go up or go down. And of course, if you can take on the assistance of a financial advisor, somebody that's really knowledgeable in this area, then it can definitely save you, can be beneficial. So you're not incurring too many losses. When we think about bonds, right, essentially, when you look at bonds, you're kind of lending money to a corporation or government entity for a certain period of time, right? And bonds are normally kind of locked in. They mature. You could purchase bonds that mature within 2 years. You could purchase bonds that mature within 5 years, 10 years, 20 years, right? So essentially, it's almost a long-term investment to say, hey, here's I'm purchasing this bond. This is the period of time. And within that time, depending on what that pays you, then that's the money you could actually earn. Essentially, bonds are purchased at what they call face value. And then what they call EE bonds are normally purchased at half the face value, right? So that's the key, distinction here. And we'll kind of go into more information around the EE bonds related to it. It was something that was started way back, and essentially when you look at it, just depending on the time frame, it could be 6 months to a year. But, with anybody that's going to be going in and purchasing these bonds, just think about it as more of a long-term investment. You're putting money aside, and that money is expected to grow over, a period of time, and then you'd essentially reap the dividend from it. Mutual funds, is another thing that we're going to discuss and cover today. Mutual funds, what it comes down to, it's a product that combines money from many investors to purchase separate investments, right? So when you think about it, and if you talk to anybody within like the financial industries, anybody that's a financial advisor, folks that work with, stocks, mutual funds, bonds, diversifying, right? So essentially what you're doing is you're kind of spreading your risk of loss across many savings and investment options. So if you're purchasing into mutual funds, those mutual funds have investments in multiple areas. And by doing that, you could essentially, just the diversification that exists within that mutual fund will kind of help you mitigate, kind of the loss across, whether it's a savings or investment, because depending on which investments actually make up that mutual fund, one of them could basically earn and one of them could be at a loss, but it ultimately, it's kind of more of a break even. So mutual funds is just kind of understanding, hey, you're diversifying, you're investing into a mutual fund. As you invest into your mutual fund, you're diversifying, kind of your options in terms across many savings and investment options. But again, it essentially just depending on kind of what's going on in the market, that can also determine what that looks like in terms of the financial reward that you could get. U.S. Treasury securities. I can tell you from personal experience, I've read about it. I've never really kind of looked into depth, but, essentially U.S. Treasury securities consist of Treasury bills, notes, Treasury inflation, what they call Treasury inflation protected securities or TIPS, and Treasury bonds, right? For U.S. Treasury securities, typically, these are the minimum purchase price per security is $100, right? And in addition to that, U.S. Treasury securities are backed by the U.S. government, right? So if you're going to look at that as being an opportunity for an investment, to look at, just kind of understand what, all the different options that are available and what this looks like. $100, is kind of your minimum purchase price. I mean, some securities go up to $10,000, $100,000, even higher. So while the, reward, while the long-term reward, may be beneficial, there is kind of a minimum purchase price, and these will definitely vary depending on which treasury notes, bills, or securities are being offered, as well as bonds. So, before you make that investment, it's always good to be able to determine what, that looks like, and of course, what the minimum purchase price is per item, and what you would need to have in within the bond, within the bill and note, or the actual bond. Retirement investment accounts, right? So when we think about 401ks, and we think about, investment accounts, these are products that are basically designed to help you save for your retirement, right? So individual retirement arrangements, which is IRAs, these are offered, by various institutions. You've also got 401k and 403b plans, as well as variable annuities. So when we think about 401ks, I think this came up in the conversation last week, where, essentially most companies will match whatever you're investing, right? And depending on how much you're looking to invest per pay period, for some companies, they'll be like, hey, we can invest up to 15, 20%, or we'll give you an opportunity to start at 5%, and we'll match that 5%. And as you increase your investments, depending on what that threshold looks like, whatever your investment is, we'll match that, right? But in addition to that, these retirement accounts, these 401ks, are kind of also, part of the total investment portfolio. And like everything else within that arena, it's, hey, we've heard of people who have lost, as the markets have kind of, gone in a different direction, and where, there's been a downward trend. In some instances, people's 401ks have lost value, right? So the goal is to definitely make sure you're investing. And the good thing is, for those of you that, may be working for companies that provide the match, always take advantage of that, because, for every 5% that you're investing, they're investing with you. So when you think about it, just based on a 15, 20, 25-year retirement plan, that can definitely be a good, vehicle to look at in terms of, financial independence in the long term. IRAs, right, may include a combination of investment products. One thing to kind of take note of, are tax exempt, right? IRAs also fluctuate with the stock market, and they include traditional IRAs and Roth IRAs. And I can also tell you that, just from something that I have learned over the years, like if you open up an IRA and there's any early withdrawals that are done on that IRA, essentially that's taxable, when, like they have to report that on their end. To the federal government. In addition to that, when you go ahead and file your taxes, it's information you have to include, because there's penalties that come. Some of them may actually have penalties or additional taxes that need to be paid, based on you withdrawing it before it actually matures. So those are just some things just to kind of keep in mind when you think about investing in, an IRA. Then we'll talk about 401 and 403, 401k and 403b plans, right? So 401, Ks are definitely established by an employer. 403, B are offered to employees of public schools and have certain tax exempt organizations, right? So that's the key difference. So if you're working for a public school, essentially a 403 would be offered to you. If you're working for a private company, a larger corporation, hey, then, a 401k plan is something that could be established by your employer. And as I mentioned, most of them, will have a matching offer depending on what your personal investment looks like for that particular plan. Variable annuities, right? So basically, what does this come down to? Variable annuity is an insurance contract that invests your premium in various mutual fund-like investments. So it's very important to understand that these can be very costly, right? You should hold the annuity for at least 10 to 20 years to justify the fees, right? Because with this investment, there are fees associated with it. And unless you're thinking about looking at it long-term, then essentially what you could be paying out in fees and what you're actually getting back in return, may not really kind of even out. So essentially, if there is an opportunity for you to, if you are looking at considering investing in variable annuities, just kind of, look at this as being a long-term, right? Because it's also associated with mutual fund-like investments, and most anything around the mutual fund basis is going to be long-term investment. So if you're saying, hey, I've got a 401k, or I've got a 403b, hey, for the next 20 years, hey, I'm going to look at investing my money in a variable annuity. This is the time frame that I would need to have that investment in place. Here's when it's actually going to be, in terms of the maturity that it'll actually have it set in place. That makes sense. Savings accounts, you can put money in, withdraw money out. So any of the other investment accounts, it's always good to kind of understand, hey, are there any fees associated with it? What is the minimum time? What is the minimum investment required? And the minimum, timeline threshold that's provided. So where you can actually, see your money that you've invested grow. So really, really important to kind of have that in place, and it's more of a long-term investment. So with that being said, activity 4, which is focused on investment products, and this is something you're able to look at in your, complete activity 4 in your participating guide. Just match each investment product with the appropriate description, right? So we've kind of gone through them, we've covered them in the, in the actual training today. So just the guide will just be to make sure you're matching the investment product with the appropriate description, what it actually entails. All right, so just a quick time check at 6:31. We are now going to be going into special saving programs. And the first to kick it off would be, what is referred to as an individual development account, an IDA. This is a match savings account for job training, education, business startup, or home down payment, right? So these are special savings programs that are out there. In addition to that, you have what they call 529 college saving plans. If we're looking at, sending kids off to college in the next, couple of years, education saving plan operated by a state or an educational institution, where it gives you an opportunity to put money aside related to either training, education, or looking at starting a business or home, or, or a down payment for a home, or, planning that college, savings plan, for somebody that, in the family that's going to be, that's looking at pursuing a higher education. So these are just, special saving programs out there that do exist as well. When we think about it, in addition to that, some other investments that we can kind of go over, first and foremost, owning a home, right? So essentially, I'm sure you guys have all known that home prices in the Los Angeles County have definitely gone up in value over the last years. Prices of homes, in some areas, definitely tend to be quite high. But when you think about it, hey, if you're purchasing a home, right, and you say you purchased the home at $250,000, great. Now, you kind of look at what you owe on the actual home, and maybe it's, the debt that you actually owe is, $200,000. Then what you'll actually have in, in what is termed as equity. So as the value of the home, as you pay down your mortgage and the value of your home goes up, the difference that you're earning on that is basically called equity. And people have used equity for so many different things. People have, taken equity out to purchase other homes, right? Or look at other different investments, or they've taken equity out, to remodel, the existing home. So those are the things that just to kind of think about. So for those, for those folks that are homeowners, it's also something to look at as, as a possible investment, right? But essentially just understand that, hey, the more equity you have, depending on the time that you've actually had the home, for those folks that may be fortunate to have already paid off their home and they don't owe anything on it, then essentially that's the value of the home. You think about what the initial value was when you purchased it and what the value is right now. Some people tend to walk away with a lot of money in equity because they purchased their homes, a few years back, and now, just depending on the development that's happened in that area or the price of other homes going up, they're able to earn additional money, through equity. And then, of course, in addition to that, just owning your own business, right? The money that, the money that you're making from your own small business, could essentially, the money that you're putting aside, that could be used for, as part of an investment for you. And that goes to be deemed as an investment, for those folks that, some people have been very successful in building a business and then selling it off, right? So whatever they may have invested initially and what the business is now, in terms of value, that gives them an opportunity, to earn a little bit more money. And of course, that goes towards the overall investments. With that being said, activity 4 of, paying yourself first action plan. So when we think about it, one thing you want to do is complete activity 4 in your participant guide. Consider 3 decision factors when selecting the best savings and investment options, right? So what's going to go into the decision-making process for you? What are you looking to achieve in the short term to the long term future in terms of financial goals, right? And of course, just remembering that a lot of investments out there that may seem like really, really good and lucrative, it's always good to be able to understand what the potential risks are. And of course, most importantly, if you're going to put money into a financial institution, it's just making sure that they are FDIC insured, right? So you want to be able to make sure that your investments and whatever you've put in is covered, should there be any potential losses. And then, of course, the second point that's here is just consider your financial goals and how you can save to reach them, right? And what does this really look like for you? How much money would you be looking to put aside per paycheck, right? How much money am I going to save per paycheck? How much money am I going to be able to save in a year, right? And then what does this look like in 5 years or 10 years, right? And the most important thing to always think about is, even if we've got financial goals and working to reach them, it's good to kind of set goals that are attainable, right? Because a lot of times some people may, set goals that are not attainable, not within reach. And then you kind of find yourself in a situation where, hey, maybe the financial savings, maybe the plan that you have in place is not, is not going as planned. And, in addition to that, could, have a negative impact. So if you're going to set a financial goal, whether it's to, hey, maybe in a year from now, whatever I have in terms of, existing credit card debt, I'm going to save money to pay off my debt, or I'm going to pay extra on my credit card debt. And in addition to that, when I've paid my credit, while my savings might be limited now, once I've paid off my credit card debt and anything that, that may be accruing interest, then essentially now you have additional money to be able to invest in your savings. And then if you are going to go and look at an investment vehicle to take advantage of, it's just really, really important to make sure that you've looked at all the aspects of it and you've taken on, financial guidance where possible. And in addition to that, starting small, and kind of working your way up is a good place, is always a good strategy. And, one thing you definitely want to avoid is just, putting yourself in a situation, if, as I mentioned earlier, if the investment is not secured, are you prepared to lose that money? And if the answer is yes, then are you willing to take the risk? Ultimately, for any money that you invest, whether it's savings accounts, whether it's IRAs, whether you're looking at, stocks, bonds, treasury notes, it's always good to know what that investment, what the best option is going to be and what that investment is going to yield for you, in the short term to the long term. Always be informed when it comes to making investments. And of course, if you're setting your goals, set those goals and then just stay consistent with them, because that will definitely benefit you. I actually once heard somebody actually throw out an acronym once, and I thought it was pretty cool. And the acronym was FIRE: Financial Independence, Retire Early. That was kind of what this person had said. I was actually listening to a podcast once, and he was like, hey, just think about it as, real simple. FIRE. If you want financial independence will allow you to retire early. So that, that's also something just to kind of consider, in the long term. If you're looking to, retire, if retirement is something you're looking at in the short term, then how much money would I need to have? What do I currently have in my savings? When we think about the rule of 72, which I covered, how long is it going to take me to be able to double the value of my money? What do I have coming in my 401k or my 403, B plan? Essentially, all those things, could definitely factor in. and, just allow you to, if you do get to that retirement point, just to kind of live comfortably.
So I have a question for the
ahead.
group. So we have done vision boards. January is all about new year, new you, and starting fresh, setting goals. Does anyone have a goal that they have set for themselves that they'd like to share? Or as we're going through this session, is there something that you're thinking, maybe this is something I want to start saving for? Because I know a lot of times when we are in groups like this, just having that synergy and talking to each other can spark a thing where you say, oh, wow, I hadn't thought about this, or I hadn't thought about that. So is there anyone who would like to share maybe some goals that you've set, or something you've decided to do this year, maybe you didn't do last year?
Good evening. This is Michelle Walker White, and I'm out walking, but also listening, so that's why I'm out of breath. Nonetheless, what I've done, additionally to saving, is I've taken 52 envelopes, numbered them, and each week I'll put in whatever dollar amount that envelope is numbered at. And so out of the 52 weeks of the year, that's another way that I'm saving money.
That is great. I've actually heard that. And there are a lot of ways you just take whatever money that you have just from change over the day and you put that in an envelope, put it away. So that is a really great idea. And I think Sharon, you had your hand up. Did you want to share?
Yes, I do the same thing. It's the 52 weeks. Each week I put in the dollar amount. But in addition to that, I was successful last year on putting away 10% of my earnings. But the thing that happened was emergencies. Once I'd gotten this amount of money, I was so happy, and then stuff started happening that I had to go in and take the money out. I'm not happy about that. And so I want to get back to that place. And I want, and I don't know if this makes sense, Jermaine, you have to tell me. I want to have a set amount in savings all the time that I can't even touch for emergencies.
Yes, thank you very much for sharing that. I think that really does make sense, because essentially, and like I mentioned earlier, emergencies are so unpredictable. We've all been in those situations. I can tell you at the beginning of the year to replace a stove, right? It was perfectly working stuff, and all of a sudden it went out. And then at that point, you're kind of like, you've got this decision to make. Do I put it on a card? But I just pay for it outright. Well, if you've got the money saved, and depending on what rate you're saving at, then that's just taking money from savings and kind of taking that in place. But I think ultimately what it comes down to, I don't think there's ever going to be an actual definitive number, but I think, when you look at it and when we think about paying yourself first, the more money you're able to save bi-weekly or weekly, and the more you can increase it. Of course, it also comes down to what your expenses and some of the other obligations will look like. That will then determine what that amount looks like. But emergencies are going to vary, from time to time. But maybe just having a goal like what you did. You saved 10% of your earnings. If you're challenging yourself to say, hey, can I take it up to 15%? What does this really look like? But then what does that look? Well, how does that really impact my current financial situation, right? Because we don't have money in savings, but then now your standard of living is kind of not where it needs to be. So I think, just always setting a goal to, kind of invest more, or maybe put a little bit more aside each pay period. It'll get to a point where you'll be able to kind of build, a sufficient wealth, but that number will vary. If you've got it in a savings account, great. If you've got it tied up in any of the other investments, then what does that look like over a year? But, I'd say just, doing what's within your affordable means, but maybe just setting a goal to where you're saying, hey, I went 10%, now let me go to 12%. Because if 10% and your savings were depleted, hey, if you want to have $5,000 in your savings account, regardless, and you don't want to touch it, that means you're going to have additional money in place to be able to kind of offset any of those expenses, which, can vary. But I think just set a number and work towards that number. Once you've got it, then just set it up in an account. Maybe you can actually put it into a different investment so you can't touch it, depending on what that looks like from the short term. But then again, it'll allow you to save money, in addition to that.
And then we had one, Tia had her hand raised. So Tia, do you want to unmute yourself?
Hey everyone, just a quick thing for if you have any young kids, or I remember when I was in nursing school, nursing school was rough and we're trying to figure out how to save money. And so my nursing instructor had told us, whenever you have a $5 bill, don't spend it. This is what she had done. And it was so interesting because I remember I did that rule. And so anytime I would buy something, if someone gave me back a $5, I'd be annoyed, but I wouldn't spend it. I would keep it in this little box that I still have. And then in December, when the holidays and everything came, that would be the money you would have. And it was so amazing how much money those $5 accumulated to be if you didn't spend it. So that's one little trick that I actually taught my children. They're grown now, but my daughter used it while she was in college, and so it was great. But for this year, what my husband and I decided is we want to take a trip to Greece. But we said, kind of what Sharon was saying, we're not going to take any money from our savings, any money that we already have saved aside. And so we've been very intentional of how much it's going to cost and what we need to do with the current income in order to get there. And that way we're not taking from the pool of money we've already saved, and we're figuring out where we can cut corners in those wants versus needs in order to have this trip. So I think that's another way of doing it, is really having that real conversation with yourself about what you want to do and how you want to pay for it. Thank you.
Thank you for sharing.
And we have one more hand and then we'll let you get back.
That's fine.
Linda?
Go ahead.
Yeah, hi, this is Dr. James. And one of the ways I like to do is I'll take my money from the checking account to the savings. And then when I get a certain amount in the savings account, to make me not even touch that money, I'll take a certain amount out of that bank, out of that savings account, and I'll open up a completely new account in a new bank, in the different banks. I don't even see it. So the money in my main account, I have a main bank that has my main money that I live off of. So any bills, anything like that, I'll have my checking and my savings for that. So emergencies come up and I have to use the savings account, I'll do that. Or I'll try to take it and put it in a CD account in the same bank. So I try to do some of the different banking options to save my money. So when I put it in a totally different bank, I don't even see it anymore. So I see the new savings amount that's there, and the other money I'm not even touching because I don't have to live on that, because that's the money that I don't even think about. That's for whatever I'm saving it for.
That's a really good example shared, and I can tell you that something else. I'll just tell you guys from my personal experience. So I have a direct deposit set up, and when I set up the direct deposit, you have the option to go 100% of your direct deposit into a checking, typically would be a checking account. Well, just taking 10% out of whatever your, biweekly or weekly income looks like, and automatically having it go to a checking account, right? To your point, could be a whole different account, something that's not tied to the existing main account. So as you're looking at your, as the pay periods come around, this is what I actually have, here's what my expenses look like, here's what my bills look like, here's what I'm gonna pay off. But it's kind of like, I'm not even thinking about the other 10% because it's not even included in the actual, the total net income that's coming back. So therefore, it's just kind of work, to like the example that was kind of brought up earlier. Hey, you're saving for a vacation. At the end of the year, if you think about it, even if you are getting paid bi-weekly, that's 26 pay periods that you're going to be essentially looking at. And just by having that being diverted in to an account and just kind of working within a set amount, of course, needs, wants, budgets, how much are you paying here? What do your expenses look like? to kind of make sure you stay, live within your means. And then, at the end of the year, when you come back and look at it, hey, here's, total 10% of your, of your biweekly income that's now going to a savings account. And it definitely does add up. So if there is a trip that's coming up, if there is an emergency that comes up, then you can kind of go to that account. But essentially, it's kind of like out of sight, out of mind for me type thing. So the fact that I don't see it in the main account, it doesn't even,
Exactly.
something I look at. So thank you for sharing those examples.
And we had a question in the chat. Says, what if you have your own business? Do you still pay yourself first?
I think it's really important, right? Because I'm sure we've all seen, and depending on, the type of business you're in, any additional money that you can save, as being a business owner will put you on a path to that financial independence, which means essentially, what does this look like in the next 15 to 20 years? What's your retirement goals? What's your, what's the vision looking at that? So, ultimately, that's, I'd say it's definitely a good best practice to have. And you might have an opportunity where you could pay yourself more. And of course, with any that you're running, depending on how much money you're bringing in, what are your labor costs? What are your material costs? What are the other expenses? Just kind of still living within your means and being able to do so, would definitely put you on a financial freedom, because who knows kind of there's so many things out there that can tend to be, like we've seen over the last 3 years, like life can be very unpredictable, and just kind of having that rainy day fund set aside for those emergencies or for those unexpected changes that come up, then that definitely will always work to your advantage.
And we have one hand raised. Rosalind, did you have a question?
Well, I wanted to just share something, with the dismal interest rates that savings have had, over the years. Wanted to just share that there are 3 banks right now, and more are coming on board, where the interest rates are pretty good, even without having to lock your money up into a CD. So they have high value savings accounts. So like Ally Bank and Amex, American Express, they pay 3.3% interest just on the straight savings. Everything's electronic. You can go on and open the accounts and use an electronic funds to transfer in. And this is without even having to go into the CD. But Synchrony Bank, SYNCRONY Bank, pays 3.75% right now for just a straight savings. That's not tying your money up. And if you do go with a CD, you can get them at different things. They're like 4.6%. But, if you just have money just sitting in bank accounts, just doing nothing, this is a good idea to try to just move it to these high interest paying savings accounts where it's liquid. You have access to it, whenever you need, without having to tie it up.
Those are very good interest rates as well. That is definitely above what the market is actually, mostly other banks have in place. All right, with that being said, just kind of looking at the, kind of going through the module summary right now. So remember the story, I think, which actually shared earlier on, hey, this is kind of just a follow-up to the initial introduction. Hey, my parents are making me pay for the speeding ticket I got, but I don't have money. Here's kind of a conversation. What am I going to do? Hey, well, if you had saved the money, your birthday money, rather than buying that purse, and then the response is, hey, I know I should have saved that money. Next time I'll put, some of it into my savings account before spending anything, right? And this is kind of what's been the conversation's discussion. How much money can you put aside? How much money can you save? And then, of course, looking at all the different saving accounts and options out there. With that being said, congratulations to everyone that's on the call. Hey, what have we learned today? We've learned what it means to pay yourself first and how you can benefit by doing it. We've learned about all the different amount of savings and investment options out there. We've also learned how to decide what savings and investment options are best for you. These will vary across the board. Most importantly, always get, the accurate financial information around it. How your money can grow with compound interest, right? And then, of course, just in the last, 12 to 15 minutes, a lot of folks have come off mute and shared, some of their best practices, which has been really informative, just kind of thinking about it, the 10%, so, somebody being able to save 10% last year, planning for a holiday trip, every $5 you get, just putting that aside, what does that look like? At the end of the year, one that really stood out was, the information shared with the envelopes, hey, just, putting money in the envelopes throughout every week. Really, really great tips on how to save money. And then, of course, last but not least, the information that we just shared right now on high value savings account, right? So how can you earn additional interest on your money, whether it's through Allied, American Express or Synchrony that was mentioned. These are all the different things that we have in place. These are all designed, tips to help you save. But most importantly, it's just about developing the habit of paying yourself first, right? That is kind of the first step moving forward. And like I mentioned earlier, right, whatever your financial goals are within, the next 12 months, like per pay period, or, what does that look like per month? And just setting that goal and being consistent in it. And then, of course, addition to that, hey, as time goes along, you can invest more, right? But like we covered last week, depending on what your needs, your wants are, your expenses, all that could also have an impact on, on what this looks like in terms of your savings account. But as long as you're dedicated to putting money aside, at the onset, then everything else will just kind of work within the budgets that you have. And of course, the goal is to definitely, attain that financial independence, that financial freedom, in the long term. So I just want to thank you very much once again for being, part of this session. I'm going to go ahead and stop sharing. I don't know if anybody else has anything else to add. We still have some time. If there's any other questions that come up, by all means, please let me know.
Jermaine, is it okay if I ask a question? I rose my hand. I didn't know if you saw me earlier.
No, so I couldn't see because I was sharing, but go ahead.
Oh, no problem. Because I just saw Michelle's go up and I didn't want to interrupt her also.
Yes.
But thank you. I did want you guys to comment, if you don't mind, on bonds, because I've heard a lot of talk about high interest rates and where to try to look for them with the market being what it is. And a lot of people have kind of gotten away from that. So can you just kind of share your thoughts about saving bonds?
I mean, I think, ultimately, I'm going to say this, Sean, I mean, I'm not a financial advisor. I can tell you that, just based on my, personal experience with it, I mean, bonds, the fact that they are backed by the government, right? And kind of when we think about interest rates and where they are right now, typically with anything in a bond, anything that we're looking at from a bond perspective, yes, while you may be able to earn, in terms of the maturity aspect, it's a long-term investment, right? And it's a 20 to 30 years. And then, of course, addition to that, it's just based on kind of where the rates are. And depending on how, right now interest rates are kind of going up. So most people might be like, you know what, I'm just going to kind of stay away from it. But for some people, it might seem like it's lucrative. But essentially, when you think about it, some people have, there's minimum investment requirements with almost every bond that's out there. And depending on how many bonds you can purchase within a year would then essentially determine what that looks like. But I would just say from my own personal experience, I think, while they do have the option to increase in value, kind of looking at what that looks like in terms of the interest rates, it's just always good to make sure that if you are going to go that route, that you've got enough information in it, related to the investments, at least, it's worthwhile for you.
I just have something to add, Jermaine,
Yes.
regarding the savings fund. That's a great question because it's kind of almost obsolete. You don't hear about the US savings bond. It's so simple. You buy it once and you just keep it for about 20, 30 years and you don't see it. Especially this is great for college savings because, if you have a child, just born, you can just start buying those savings bonds and putting it away when that child is ready to go to college, and usually the savings bonds, as you know, if it's a $50 bond, you pay half of that price to buy it, right? And then if you keep it for the term that it says on the bond, then it doubles, and then it kind of brings you that face value of that bond. If it's a $50 savings bond, you only pay 25, but it becomes 50, but it takes a long time to double that money. So that's the only thing, and it's great for savings for long term, like college savings, or if you're planning to buy a house in the next 10 years, you don't want to look at it and you religiously buy those savings bond and put it away. Some people put it in the safe deposit box or somewhere safe in the home, and then when they're ready to redeem, they can take it to the bank and they can just cash it in. So that is simple as that. But now that so many investments have come about, and kind of doubling your money in a shorter period of time, I think that, but also you face a very high risk because you could lose the money. So that's the difference between just a US savings bond and a investment that can be risky but can also double your money. I don't know if that answered your question, but the question was asked. I'm sorry, I don't know who it was. So.
All right. Thank you, everyone, for your input, your questions, your comments. And we have a couple of polls that we're going to do before we finish. So the first one, we are going to just asking, can you guys see it? It's
Yes.
a question, why is saving important? So it's just a real quick, is it having money for emergencies? Is it achieving financial goals, improve standard of living, or all of the above? All right, and we'll share. So it is all of the above. And I want to thank everyone. So we will include the participant guide for the next session. We'll send that out when we send out the reminder, but you all should be able to go into the link and you'll see this participant guide for session 2. And this is the pay yourself. And Jermaine, did you want to share what the topic for our next session will be?
Yes, I'm actually just pulling it up right now, and I think it's actually going to be credit reports and scores. So very nice, very good topic.
All right, so we're going to be talking about your credit scores. Yes. What's good?
That's good. How to, how they calculated, some of the things to look out for, so yeah, we're going to cover that next week. So credit scores and reports will be part of our discussion next week. So very, very informative, just on some of the information you can look at related to your credit report, credit history, and how that can have an impact, just in terms of the money that you borrow and how much you have to pay in interest. I mean, credit scores are really, really critical, right? And of course, when we think about those long-term financial goals, I don't think you can rent an apartment now without them running a credit check on you. Most, folks would look at it as well. So, just understanding kind of how those are calculated and how, and the best practices around it, then that's something that, we're going to look at.
Okay, so thank you. And if anyone has any questions before we go. So we just have a couple thank yous in the chat. Thank you. This has been a great session. And if we don't have any more questions, then we're going to let you all get back to your evenings, and we look forward to seeing you next week.
Thank you.
Have a great night, everyone.
Thank you. Have a great week. Great session.